Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are trying to hide in plain sight. Today we are diving into a special report from CNL Strategic Capital LLC. Get ready because this filing is a bit of a mixed bag, revealing some key leadership changes and a close look at how the company's investments are performing. First off, this report is officially a Form 8K, which is basically a report for current events that are important to shareholders. Think of it as the company's way of giving us a heads up on significant happenings. They are letting us know about two main things, a director stepping down and a new one stepping in. Plus, they are giving us the latest financial scoop on their net asset value and public offering prices. So, let's talk about the people at the top. Arthur Levine, a director since way back in 2016, has announced he is leaving the board. He is not leaving because of any squabbles with the company, but rather it is part of some bigger succession planning at his other company, Levine Lightman Capital Partners. Or LLCP, he is still staying on with LLCP, so he is not disappearing from the investment world entirely. Taking his place is Andrew M. Schwartz, and his appointment is effective the 1st of November, 2025. He'll be serving until 2027, and importantly, he is considered an interested director because of his past leadership roles at LLCP and his experience in acquiring and managing businesses. The company is clear that they won't be paying him separately for this director role, because he'll be compensated by affiliates of their sub-manager. Now, let's see a little more about Andrew Schwartz. He's been with LLCP since 2011 and is currently a partner. He plays a big role in managing their US investment team, focusing on strategy, deal making, and overseeing their US businesses. Before his time at LLCP, he was a vice president at Liberty Partners and an investment banker at Jefferies. He's got a solid educational background too, with degrees from the University of Pennsylvania, including economics from the Wharton School and computer science from the School of Engineering. Moving on to the numbers, which is where things usually get interesting. This section talks about the company's net asset value, or NAV, for each share class as of the end of September 2025. NAV is essentially the value of the company's assets minus its liabilities divided by the number of outstanding shares. Let's break down this financial table. It shows the net asset value for different share classes like Class FA, Class A, Class A, Class D, Class I, and Class S. For Class FA, the net asset value was $162,757, and the number of outstanding shares was 3,871. The net asset value per share for Class FA was $42.05. Comparing this to the prior month's NAV per share, which was $41.82, we see a small increase of $0.23. This pattern of slight increases or minor decreases holds true across most classes. For example, Class A has a NAV per share of $37.51, up from $37.48, a $0.03 increase. Class I, which has no upfront sales load, shows a NAV per S-share of $37.96, slightly down from $37.98. The report explains these changes are mostly due to the shifting fair value of their investments. 10 out of 17 portfolio companies saw their values go up, which is good news. However, 5 companies saw their values decrease, and 2 remained the same. Overall, right at the end of September, the company had total assets of about $1.43 billion. Now, let's talk about the price at which new investors can buy into the company. On the 23rd of October, the board approved new public offering prices for each share class, which will be effective starting the 30th of October, 2025, for shares bought through their dividend reinvestment plan. The price will be the NAV per share as of the 30th of September. Looking at the table for these new prices, Class A shares will have a public offering price of $38.99, Class T at $37.15, Class D at $35.24, and Class I at $35.96. Keep in mind that for Class A, there are selling commissions of $2.1 per S-share and dealer manager fees of $0.99. Per share, Class T has commissions of $1.02 and fees of $0.69 per S-share Class D, and Class I don't have these upfront sales loads, which is a significant point for investors looking to put their money in. Next up, distributions. On the 23rd of October, the board declared cash distributions for all share classes. For those paying attention to dividend dates, the record date is the 25th of November, 2025, and the payment date is the 26th of November, 2025. The declared distribution per S-share for classes FA, A, I, and S is $0.104167. Class T shareholders will receive $0.08333 per S-share, and Class D shareholders will get $0.09375 per S-share. This next table is a big one, showing us the performance of the company's different share classes over various periods. It covers year-to-date, 1 year, 3 year, 5 year, annualized returns since inception, and cumulative total returns. For the year-to-date period, meaning from the 1st of January to the 30th of September 2025, Class A shares without a sales load showed a return of 8.6%. Class A shares without a load did 7.9%, and Class I, which also has no load, returned 7.8%. It is interesting to see that Class S shares, even with a sales load, clocked in a 4.8% YTD return. Looking at the last 12 months, Class A without the load returned 12.6%, Class A without the load 11.7%, and Class I 11.4%, even Class S with a load managed 8.7% return over the past year. This suggests a generally positive performance in the recent past. Now for the long haul, the cumulative total return since inception for Class A without a sales load is a solid 123.1%. Starting from February 2018, Class A shares have seen a 104.4% cumulative return since April 2018. Class A shares are right there with 106.0%. What is key here is that the performance is generally better without the sales load, which is expected. Investing with a load up front means a portion of your initial investment is immediately gone, impacting your total return over shorter periods especially. This next table is crucial as it breaks down where the declared distributions are coming from. For the 9 months ending the 30th of September 2025, about 45.6% of the distributions came from net investment income, which is like the core earnings from their operations. Another 4.5% came from net realized gains, meaning profits from selling investments. However, a significant 54.4% of the distributions were described as distributions in excess of net investment income and net realized gains, which means they were funded from other sources, likely offering proceeds or past capital. Digging deeper, we see that net investment income before expense support was $14,470,000, representing 45.6% of total distributions. The distributions in excess of net investment income and net realized gains amounted to $17,262,000, making up the large 54.4% chunk. This means a substantial part of the distributions is coming from the company's own capital or proceeds from selling shares rather than its operating profit. When we look at cash distributions net of reinvested amounts, 92.2% came from net investment income, but this includes $1,017,000 in expense support from the manager and sub-manager. Net realized gains provided 9.1% of these cash distributions. The large distributions in excess of net investment income and net realized gains is a critical point. It signifies that the company is covering over half of its distributions through means other than its current operational earnings or investment profits. This is often funded by the money raised from selling new shares. A common practice in some investment funds, but it can be a red flag if the core business isn't generating enough to cover these payouts on its own over the long term. Looking at historical data, they've had periods like 2020 and 2019 where a significant chunk of distributions, over 30%, came from offering proceeds. This suggests a pattern where they rely on new capital to supplement payouts. The report also warns that if they receive additional expense support, they will have to repay it in the future, which could hit future income. Finally, the report lists exhibits. The most interesting one here is Exhibit 17.1, which is Arthur Levine's resignation letter. It is filed with this report giving us the official record of his departure. So, what is the big picture here? CNL Strategic Capital is navigating leadership transitions while providing a transparent look at its financial performance. The NAV shows stable, if not slightly growing, asset values, which is generally a positive sign. The dividend declarations are also a key part of their investor appeal. However, the distribution sources table raises a point of caution. A significant portion of the distributions being paid out comes from sources other than the company's core earnings or investment gains. While this might be a strategy to provide consistent income to investors, especially in certain types of funds, it relies on the continuous inflow of new capital or successful asset sales. The dependence on these external sources does present a risk if market conditions change, or if new capital formation slows down. Their long-term cumulative returns look good, especially without the sales load, but understanding where those returns come from is critical. The company is trying to be upfront about it by detailing these sources and historical trends. Overall, CNL Strategic Capital seems to be managing its investments and leadership effectively, but investors should pay close attention to the sustainability of its distribution payouts. always keeping an eye on the quality of earnings and asset value growth versus reliance on capital inflows. Alright, that is our breakdown of CNL Strategic Capital's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.